Markets worldwide are back to tumbling on Thursday as worries about a fragile economy roar back to the forefront. The S&P 500 was 2.8% lower in early trading, more than reversing its blip of a 1.5% rally from a day before. And analysts had warned of more big swings. This comes as deep uncertainties loom over the Federal Reserve and other central banks' ability to manage inflation. And it's a narrow path of hiking interest rates, enough to slow high inflation, but not so much that they cause a recession. Joining us now to give us his outlook on the markets and whether investors should be concerned is Brendan Caldwell, Director of Caldwell Securities Limited. Brendan, welcome back to Forum Daily.
Thank you, Nima. Couldn't have picked a better day, could you?
Definitely. Now, we mentioned the U.S. Federal Reserve just raised interest rates by 0.75%. We're hearing from economists that the Bank of Canada is likely to mirror that move next month. But what does all of this mean for consumers regarding their credit cards, mortgages, and overall debt?
Well, if you're carrying floating rate debt, credit card, or any debt that can float higher, you really should look to get that paid off, or to switch it to a fixed rate if you can, or something. Because my strong view is that interest rates are going to go much higher from here. The Bank of Canada and the U.S. Federal Reserve has signaled as much. So if you have the ability to pay off your debt or put a fixed term on your debt, whether it's your mortgage or anything else, I'd make that happen.
Some important advice there. Now, I've heard of the term stagflation a lot at this time. What does that mean, and are we in it, Brendan?
It means I'm 8 or 9 years old again. Jimmy Carter's president of the United States. Interest rates are on their way into the double digits, and the economy's not growing. So it's the world we had in the late 70s, where prices were rising, seemingly out of control, and yet the economy wasn't growing. So stagflation is the combination of stagnation and inflation, which from an economist or a real person's point of view is the worst of all worlds.
And it's interesting that we've been experiencing a bull market for over a decade now, Brendan, but there hasn't been a lot of talk about a bear market, which we're in right now. So why is it called a bear market in the first place?
Well, there are a number of explanations. The analogy of bull and bear: bull is a market that's going up. I guess it means like it's charging ahead. And a bear market is where it claws back all of those gains. And it has hair like this. So a bear market is one where you've got a correction of more than 20%. And a number of the major, particularly U.S. indexes, are in bear market territory now. The Canadian market, because of the preponderance of natural resources, particularly energy and gold, have held up somewhat better. But the tech-heavy indices in the U.S. have come off quite a bit.
You can see why investors are concerned. So should they consider selling everything right now and staying in cash?
Only if you have a near and pressing need for the money. All money's meant to be spent. So if you know in 3 months or 6 months you're buying a house, or you needed this for this or that specific purpose, then yes, probably, because I cannot tell you how it's going to be in 3 or 6 months. But if you have time, as we've discussed before, I would consider adding to this market, not all at once, but put in $1,000 this month. Do $1,000 next month. I cannot tell you whether this month or next month's purchase will be right or wrong, but if you've done the first purchase, whether the market goes up or down, the next one becomes that much easier. And as you start to accumulate money in savings, in investments, that will grow over time, almost no matter what the market does, because eventually it will recover even from the worst of bear markets.
There's always a light at the end of the tunnel, Brendan. Now, just about a minute left here. I want to jump to the R word, recession. We're hearing a lot of concerns around a recession considering these interest rate hikes. Are we there yet? Are we in it? What are your thoughts, Brendan?
Well, the light at the end of the tunnel can also be a train, as you know, Nima. But recessions generally follow interest rate hikes when they're pointed like they have been now. And that's actually kind of the point of the interest rate hikes themselves, is to slow down the economy. But they usually fall in like a year, 18 months after interest rates start to be hiked. In the interim, you're still going to see, I think, wage pressures and inflation pressures, some of it demand driven, people demanding higher wages, but some of it is also supply driven because there is still a shortage of numerous commodities, and from houses to oil to bread wheat. So I think you're going to see inflation, possibly stagflation, ahead of possibly a recession over the next 18 months. But it doesn't necessarily mean people should be running for the hills, because here and there will be opportunities in the market.
All right, Brendan Caldwell, always great having you on Forum Daily. Thank you again for a very informative interview today.
Thank you, Nima.
We'll be right back.